Hi, and welcome to another Marshall Reddick Real Estate educational program and investment opportunity. My name's Patrick Prunty. I'm glad to be with you today. A little bit about myself on the screen here. First and foremost, I've been with Marshall Reddick for a little over 12 years now, and I practice what I preach. I'm an investment property owner, I'm a private money lender, and I've got the credentials here to make it happen. Today, our presentation is going to be about how you can become the bank and collect mailbox money. You can actually become the bank and be the lender. And that collecting mailbox money, that's just a kind of play on words that I've really adopted. And I love it because there's just nothing better than getting paid for literally doing nothing. So I'm going to show you how you can do that today. Before we get started, consider landlord as the term of the day. So you want to, diversify your portfolio with a little bit more passive investment and own the paper, not the property. So instead of becoming the landlord, consider becoming the landlord. A lot of times I get asked the question, how do you actually make the investment? How do you actually do this? And it's simple. You can do it one of three ways. First, you can provide a purchase money loan. And this is simply you lending the money to a borrower at the initial acquisition of the property. That's a purchase money loan. Second, you could buy an existing loan in the secondary market. This would be in a loan that's already been originated and which the borrower already has in place, and you could buy it from the existing lender. Third, you can refinance an existing borrower's loan, or if the homeowner owns the property free and clear, you can provide what they call a cash out refinance. In either case, you become the bank. It's that simple. Also important for you guys to understand that this investment opportunity is not a syndication. We at Marshall Reddick do have some syndication type investments. However, you would actually be playing the bank and you would be the lender. You wouldn't be putting your money into some type of pooled program or partnership. Also, important to understand as investors what we're concerned with. First and foremost, at least for me, I'm concerned when I'm investing my hard-earned money in protecting principal. I work too hard for it. It's so hard to save as it is that I need to make sure that I'm investing in something that's safe. Second, I would be concerned with balancing risk versus my desired rate of return. What's your risk appetite? Is it worth the return that you anticipate getting from that investment? Third concern with is diversifying the portfolio. Now, our programs accomplish all 3 points. Now, understand that every investment has its risk. If anyone's ever sitting there talking to you about an investment or has an investment opportunity for you and they tell you that it's guaranteed or that there are no risks, you got to just simply turn and run the other way. Now, ours is no different. It has its risks, but we minimize our risk, and I'll tell you about that today. So basically, we have 2 programs. Very simply, long-term and short-term, and I'm going to dive into both of those today. On the short term, we're talking about supporting the fix and flip business of our regional representatives. Okay, so you as the lender would be lending to our trusted regional reps, people like Ryan Tucker in Memphis and Jim Moody in Toledo, Ohio. You'd be providing a purchase money loan to these reps in order to help them acquire, fix, and sell property. Let's dive into that short term. Basically, we're talking really short term, 12 months or less. Okay, so the promissory note would be drafted up for 12 months. That's standard across all of our short-term loans. As I mentioned, that loan that you'd be providing as the lender would be used for them to acquire distressed property. Could be REO, could be short sale, could be any number of things. In any case, they acquire the property, they renovate and add value to the property with the exit strategy of simply selling the property for a profit. Now, important, listen up here in regard to the loan to value on the short term. Okay, so it's based on the after renovation value, which also could be called after repair value, and for short we call that ARV. That's based on a broker's price opinion. And we're comfortable at 75% maximum LTV. Okay, so 75% max loan to value based on the after repair value. I'll dive into that a little deeper, but first it's important to know that we're getting fantastic returns on these loans, anywhere from 9 to 12% depending on the market. Also important to note here that all of the loans and all of the lending that we're doing in this program is all first position lending, so very secure. Okay, let's dive into a short-term example so everybody's clear. On this property here in Memphis, let's just say that the after renovation value was $100,000. Okay, now let's also say that the acquisition cost, so our regional representative has this property under contract for $50,000. Okay, the property needs some work. We've identified that it needs about $15,000 worth of work, and we've reviewed that scope of work. So in this case, the regional rep needs a loan amount of $65,000, right? Now, what is that loan to value? Well, it's based on the after repair value, so a loan amount of $65,000 based on that $100,000 after renovation value is 65%. This is under our 75% maximum threshold, so we're comfortable with this loan. Let's look at a just slightly different scenario on the same property in Memphis. In this situation, we still have a $100,000 after renovation value. Our acquisition cost still is $50,000, but in this case, the renovation budget came in much higher at $35,000. Now, if that 50 and 35, that would be an $85,000 total that they need to do this. However, that would put us over a 75% maximum loan value. So in this case, the max loan amount we'd be comfortable lending would be $75,000, which would bring us right in at our max loan to value of 75%. In this case, if the borrower, our regional rep, still wanted to do the deal, they'd have to come out of pocket with $10,000 additional in order to cover that additional renovation. We, however, would never be more comfortable lending more than the 75% of the verified after renovation value. All right, moving along. How do we build this program? Well, we basically, as individuals and as a business, started lending our own money, and we continue to do this, right? So the regional reps came to us and said, hey guys, I've got a ton of distressed property in my footprint, in my metropolitan area here where I live, and I'm buying as much of it as I possibly can, and I'm renovating it, and I'm reselling it, I'm flipping it, and I'm doing a great business. However, there's more opportunity. Would you be willing to lend me some money for an interest rate as an investment to help us continue to build this program? And so we said, yeah, we understand residential real estate. That sounds like a very good complement to buy and hold, and it looks a little bit more passive. Besides the interest rates that we want to charge, we can get those, and it makes sense. So understand that today, over about a 5-year period since we've been doing this internally, we've funded and successfully closed hundreds of loans. But we're small and conservative. So on average, about 10 to 12 loans per month, we here at Marshall Reddick are funding and also closing. Our program continues to grow, and so at this point, we're finally ready to open it up to you, our Marshall Reddick clients. In the short term, we have one loan program available. As I mentioned a little bit earlier, it's 12-month term. Okay, so what that basically means is that the longest your investment would be out is 12 months, which would be maturity, right? 75% maximum loan to value, again, based on the after renovation value. The interest is paid on a balloon, right? So there are no monthly payments. Your interest accrued throughout the term of the loan would be paid at resale of the property or at maturity, whichever first occurs, along with your principal investment. The rates, again, we get are 9 to 12%, and it varies on the market in which you invest. In the short term, all require, of course, escrow and title insurance. Homeowner's insurance is mandatory, and of course you get my approval, Patrick Prunty's approval. All deals that come through Marshall Reddick are evaluated and underwritten by me. And guys, I've done enough of these loans to have the experience and know what to look for. and understand that all the opportunities that make it to you, I would invest in myself. And frankly, I'd take them all if I could. However, my personal capital and our business capital is limited. How do you get started? If this looks good and you think you'd like to earn a passive return by investing or lending your money, complement your portfolio, your buy and hold rental portfolio, what are we going to do? We're going to have an initial call where you can express interest. We're going to talk about the amount that you're interested in lending and where those funds are located, whether it's maybe in a self-directed IRA, whether it's in cash, or whether maybe it's in stocks or something else that needs to be liquidated into cash so that we can get you ready to become the lender. After we get to that point, I'll know what it is that fits your criteria, and when I come across a deal that makes sense for you, I'll send it to you for review. Now, what does that presentation look like? I'll send you something nice and neat like this. It's going to give you the property address. It's going to give you the borrower's information. It's going to give you the specifics on the property, so beds, baths, square footage, when it was built, what the market rent would be after it's all renovated. It's also going to give you the specifics on the acquisition. So in this case, this property on Rains here, the acquisition property under contract is a little over $32,000, and the renovation budget that we've reviewed is about $17,000. Okay, so the total loan amount to our borrower in this case is a little under $50,000 there at $49,320. Always a promissory note of 12 months. Again, we're always in first position, and this particular loan offers a 10% annual interest rate. The after renovation value here we've identified at $78,000. Now that makes our loan to value coming in a little over $60,000 at 63.2%. Right. I also always give you the anticipated project time frame, which we're really short on this one, looking at about 120 days. Lastly, I always give you who our intermediary, who our escrow is going to be. In this case, it's the Jewel Law Firm in Memphis. We always use a local title and escrow company. Now, I guess a bunch of other of you guys are going to be asking out there is how do you verify that after renovation value? Well, just as an appraiser would, I'm going to look at the comps. Okay, so I'm going to show you a document just like this that's going to have the subject property across the top, and it's going to list some non-distressed equity traditional sales in the local market. Notice in the far right column, I've got the distance from the subject property, so you can tell that these are all very close. And as you look across at the beds, baths, year built, garage square footage, sales price per square foot, and close date, you can see that these are all very similar properties that have all recently sold and are all very good indicators of what the property on Rains will sell for after it's been renovated. Okay, so this is how I establish my after renovation value, which again establishes the maximum loan amount I'm willing to lend to the regional rep. Okay, so after you get that presentation from me, I give you some time to take a look at it, and then you ask questions. If you're not clear on something, then we'll have a conversation generally the next day. So we have a short timeline here, and then ultimately you're going to commit or pass. If you commit, excellent, move on to the next step. If you pass for some reason and that particular opportunity just wasn't for you, I'm going to ask you why. And I'm simply going to ask you why so that I can refine your criteria and only put deals in front of you that make sense for you. After you commit, we're going to determine what the vesting for the loan documents will be. So if you're doing this in a self-directed IRA, we're going to know that information. If you're doing it as an individual, that's great also, but perhaps you have an LLC or a corporation in which you'd like the loan documents to be drawn. I'll then contact the escrow holder, like in our example, which was the Jewel Law Firm in Memphis, and I'm going to alert them about you being the lender, and they're going to prepare the loan documents. Okay, so escrow prepares those documents. They're also going to obtain a title insurance commitment to make sure that the borrower gets clear title of the property, and also that title insurance is extended to you as the lender. That's something we put in there to protect everybody. Nonetheless, the loan documents will be drawn. Now, you as the lender don't sign anything. You just approve the documents. So after the loan documents have been drawn, we're talking about promissory note and deed of trust, they're going to send them to me for review. After I review them and all the I's are dotted and the T's are crossed, I'm going to email them to you as the lender for a second pair of eyes to take a look and review. You'll then email them back to me and say, Pat, we look good, we are approved. Move on into the escrow process. The borrower will be required to purchase homeowners insurance, and you as the lender will be listed as mortgagee, right? That's important to know that the policy is in place, okay? We'll then move to the closing date, at which point you will, as the lender, wire the funds into the escrow holder. Your money never touches anybody else's hands but the escrow holder, not Marshall Reddick's hands, not the borrower's hands. The borrower will then go into the escrow office and they will sign the loan documents that you previously approved, and the escrow holder will settle the transaction. Most importantly, as the lender, that trust deed or mortgage, the security document that was signed by the borrower, will be sent to the county recorder to be recorded, making your loan a public record and therefore protecting your investment. What happens next? Well, the best part, you collect mailbox money. Now, again, we had talking about risks. So how do we minimize the risks in the short-term program? Well, first and foremost, all the evaluation, the analysis, and the underwriting, it's all done in-house. We here at Marshall Reddick have been doing this for years. We understand residential real estate, and so we are able to get this done successfully. Next, we only lend to professional groups, our regional reps that I talked about, with which we have a long-standing relationship based on trust. No weekend warrior that's been watching HGTV can call me up and ask for a short-term loan. We simply don't lend to groups that we don't know and that we don't trust. The screen here, you can see the areas around the country in which we are currently have a relationship with a regional rep and are extending short-term loans to them. Okay, so whether it be somebody like Joe Presta in Phoenix, whether it be Ryan Tucker in Memphis, Tennessee, or whether it be good old Jim Moody in Toledo, Ohio. It's the regional rep that we've worked with for years that is the borrower that is using these loans to fix and flip residential real estate. Let's look at a quick case study, right? So I'm doing this with a number of Marshall Reddick investors just like you. And in this case, at the top, you can see the top 5 loans are all loans since 2014 that have been funded and closed by one particular lender. I've got the funding date there. I've got the number of days out. That means the number of days from the time the loan was funded until the property was completely renovated and resold and the resale escrow had closed. So as you can see, these are very short term. I've also included the interest that this particular lender earned on each deal based on the loan amount and the interest rate. I also included the averages across the bottom there, so you can see that of the 5 loans that have closed and funded, the average time out is under 4 months. Okay, so although we do have a 12-month promissory note, the average time that I'm seeing across all of the loans that I've funded is about 160 days or so. Okay, so in that amount of time, you would anticipate getting your interest and principal back at the resale close. The loans there on the bottom are simply the loans that are in play for this particular lender who's gotten comfortable with me. And so they constantly have about $150,000 out at any one time, and they're earning a great return, a very passive return, might I add. Okay, that's the short term. Now we're going to move on to the long term. In the long term, we're simply talking about 5 to 30 years. And before I go any further, I forgot to mention here that the long term is used to support our buy and hold investor acquisitions. Okay, so we have a ton of residential real estate investors who are building portfolios of residential property. Now, at some point, they're unable to qualify for conventional financing anymore. You know, for those of you out there who own 10 or more rental properties, you know that Fannie Mae and Freddie Mac will not lend or buy the loans in the secondary market when you have more than 10 loans. right? So if you have more than 10 real estate loans, you can't get a conventional mortgage. In that case, the investor who desires to buy more rental property needs to obtain private loans. So it's those individuals or those who are maybe buying with a self-directed IRA and need a non-recourse loan that have to go privately and come to us at Marshall Reddick for their lending needs. All right, so with that understanding, the borrower is using a loan, could be anywhere in the range of 5 to 30 years. Okay, now a lot of you might be saying, man, I'm going to lend my money for 30 years. Well, the fact of the matter is, guys, is simply that nobody holds their 30-year mortgage. Ask yourself, when you bought rental property or you purchased your primary residence and you got it on a 30-year fixed mortgage, did you hold it more than 10 years? Probably not. You probably refinanced for a lower rate, paid off the original loan, or you sold the property, or you simply paid it off. Okay, these statistics show that the average is about 7 to 9 years nationwide that 30-year mortgages are held for. Now, as I mentioned, these particular loans, and which you'd be the lender for, are used by other investors for buy and hold residential real estate. It's important here that I also note that we don't do any owner-occupied financing. It's all investment-based. Now, the 3 bullet point here, non-recourse, more than 10 finance, or loan amounts under $50,000 are the common reasons why investors need private loans. It doesn't mean that they have bad credit. Now, the exit strategy here is simply that they're going to sell or refinance the property, or they're going to pay it off over the term of the loan. Totally different from our short-term program, the loan to value is based on an appraisal. So just like a regular bank, we're going to have a third-party appraisal on each property. We're also going to lend a maximum of 60% of that appraised value. So very, very low risk. And at the same point, we're still earning an awesome return. 7 to 8.5% fixed rates on our programs are an absolutely amazing return. I ask you another question. Are you earning that type of return in your retirement account? Is your financial advisor providing you that type of return? If they are, can I have their number? Because I need to give them a call. My financial advisor is certainly not returning 7 to 8.5% in my portfolio. Now, let's dive into how that actually works in an example. So this particular property in Toledo, Ohio, let's say again that the appraised value is $100,000, right? So in this case, purchase price is also $100,000. Right, so the property appraised for what this particular borrower was buying it for. Now, the down payment then we would require is 40%. So the borrower would be putting down $40,000. You as the lender would be lending the difference, which is 60% max loan to value based on that appraised value. Right, so 60,000 divided by 100,000 gives us our loan to value. All right, let's talk about a slightly different example, and perhaps the property appraised a little bit less than the purchase price. Okay, in this case, we would ask that the borrower put a larger down payment if they still wanted to go through with that purchase. Okay, that would then lower the loan amount to $54,000, which is again 60% max loan to value. If the borrower wanted to go through with this purchase, totally their prerogative whether they want to do it or not, but we'd require them to put down the extra $6,000 to make the deal work. Now, how do we build the long-term program? Well, simply, we are investors here at Marshall Reddick, and we build relationships with investors. We identified a need of our investors, which was loans that they need to buy additional rental property to build their portfolio. Now, it also was born out of the fact that we had clients like you who have done the buy and hold rental real estate and understand that while it's passive, it's certainly not as passive as you'd like. You still have to manage the property manager. You still have concerns with tenants, maintenance, vacancy, etc. So we're putting you into a situation where you can become the bank and you can collect mailbox money in a truly 100% passive manner. Now, the long-term program, we have 3 loan programs available. The first is a straight 15-year fixed. That carries the lowest interest rate at 7%. You could also choose, as the borrower, a 30-year amortized payment with a balloon. that balloon would either be at 5, 7, or 10 years. Okay, so as the lender, you don't get to choose these programs, right? But you'll understand what they are and get to choose whether you want to fund a particular loan that's available or not. The borrower, again, gets to choose these. And then our third item there, our third loan option, is a straight 30-year fixed at 8.5%. Right? Again, 60% max loan to value, and all of our long-term loans require a 3-year interest guarantee, right? So you as the lender, you're guaranteed 3 years worth of interest. We, of course, have an escrow and title insurance requirement, and, of course, homeowners insurance. Lastly, you get my approval. I underwrite every deal that comes through, and it doesn't make it off my desk unless I approve it and would do it myself. Now, same situation as in the short term. We're going to have an initial call to express interest and talk about where your funds are and what we need to do to get you ready to become the bank. After I evaluate and underwrite deals that make sense and fit your criteria, I'm going to show you what they look like. Now, a little bit different presentation, but pretty similar to our short term. In this case, I'm going to show you all the specifics about the property. I'm also going to show you what the loan amount's going to be, what the down payment's going to be, what the program is that the borrower has picked. In this particular situation, which we funded a couple of months back, this particular borrower wanted the 30-year amortized payment with a 10-year balloon. So that means at the 10-year mark, he has to do something if he hasn't already paid it off or refinanced, etc. And this carries a 7.5% interest rate. So this particular lender lent just under $30,000 at 7.5% interest, is looking at a $6,655 interest guarantee, which I'll get to and explain a little further. And the monthly payments they're collecting are just under $210. Right? So what's next? Well, I'm going to present to you what the amortization schedule actually looks like and some more specifics on the loan. So I want to draw to your attention here is the interest column, right? So out of those $209.75 payments that are applicable to this loan, you can see how much of that is interest. So guys, as the lender, you are just sitting back collecting mailbox money. And the interest guarantee, of course, I wanted to explain that, is can be found in the far right column where it says cumulative interest, right? So over the first 36 payments, which is the first 33 years, the interest per the amortization schedule would total $6,655.39. And so while the borrower could certainly pay this off earlier or refinance and pay it off, they can't effectively get out of this unless they pay you as the lender that minimum interest guarantee. So same concept. I'll send details like this your way. You review and ask questions, and then you commit or pass. After you commit, exact same process as before in the short term. I won't go over the details again, but you can see them here on the screen. They are exactly the same. Ultimately moving through until escrow settles the transaction and records that trust deed or mortgage, thereby securing your investment. And again, my favorite slide of the whole presentation, you collect mailbox money. That's exactly what happens next, is that you'll just sit back and collect that passive income. Now, in the long term, how do we minimize the risk? Well, we control the whole ecosystem. We only lend on Marshall Reddick approved property in Marshall Reddick approved markets to Marshall Reddick borrowers. Like I said, we control the ecosystem. Again, we're only going to lend 60% loan to value maximum, which is based on an appraisal. And we're also throwing in a caveat that the subject property, the property you're lending against, must cash flow, right? So in the event, it's hard to believe that someone putting down 40% in collecting rent is not going to cash flow. But in the event that was the case, we would simply ask the borrower to put down a larger down payment until the subject property does cash flow. On the long-term side, we're also going to recommend that you use a loan servicer. This is just a middleman that will collect the payments from the borrower and remit the payments to you as the lender. You don't want to talk to the borrower, just like when you own rental property, you don't want to talk to the tenant. So the loan servicer acts just like your property manager, right? Okay, Marshall Reddick, and what is our role in this program? Well, we are the ones that are going to be evaluating, underwriting, and providing the private lending opportunities. We're going to be communicating between all parties. So that means both you as the lender as well as the borrower, the Marshall Reddick client looking to buy the rental property. We simply will coordinate with the realtors, the inspector, the appraiser. All of these, we take care of all of that. We don't expect that you'll have to do anything of that nature. We're also going to coordinate with escrow and the attorney and the title co. Make sure that all documents are dialed in, all the I's are dotted, and all the T's are crossed. And last but not least, knock on wood, we would coordinate in the event of default. Now understand, guys, as the lender, the worst case scenario is that you'd have to foreclose on the property and take back that collateral. Now, we haven't had a foreclosure in our program, but previously in this presentation, I told you that we've funded and closed successfully hundreds of loans, and that's no joke. And we expect to continue to do so, and we haven't had a foreclosure. Now, while we don't anticipate having one, that is a possibility. We are in the lending business, so you have to know that when I make this investment, the worst case scenario is I will take back that collateral property, and Marshall Reddick will help you in the event that we had that happen, right? So ask yourself, when you're looking at investing in a loan like this with us, be comfortable with owning that property that you're lending against for the amount that you lent. Plain and simple. Again, we haven't had a foreclosure, but in the event we do, we will be here to help you through that process and regaining that collateral. So, I wanted to keep the presentation short. I'm sure you've got more questions. If you're interested, you want more information, let's have a conversation. Got my contact information on the screen, so I appreciate your time and enjoy your day.